Welcome everyone. Welcome everyone. I hope you guys, all of you haven't waited long. Thank you for joining us today. I can see lots of people joining now. Thank you very much, guys. Thank you for waiting. Thanks for your patience. We're just going to wait for a bit. I can see that some of the attendees is trying to adjust for their audio, their videos, their sound. So we're just going to wait a little while, and then I'm going to start. Thank you for your patience, guys, everyone. Welcome again, and thank you for joining us at today's webinar. It's really excited to have all of you that wait patiently for the past few minutes. And before we start, I just want to quickly introduce myself. My name is Grace. I'm one of the team members at Mega Property Group. Mega Property Group is one of the leading project marketing agencies as well as property agency companies based in Sydney that provide one-stop solution for home buyers and property investors. So I can see we have quite a lot of attendees joining in, and we are going to make a start. Now, before we get started, I would like to begin today by acknowledging the traditional custodians of the land on which we gather today and pay my respects to their elders, past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. So everyone, we've got a great webinar ahead of us today. And the star of the show, of course, being David. He's one of the founders and chairperson of Mega Property Group. With over a decade of experience and a track record of successful projects worth over 700 million, David is sure to offer invaluable insights into the current state of the industry. Now, so today, David is obviously going to share with us some amazing insights about the rapidly changing property market, plus his own take on what's going to happen to the Australian housing market. After the much anticipated interest rate hike by RBA and the implications of the election, as we all know, the Labour Party has won the recent election in New South Wales, as well as some shocking banking crises happened in America recently. So these will be some of the themes of this webinar, where David will share with us on strategies to secure our financial future. Now, so before I get out of the way, just a little housekeeping before I pass the time to our chairperson, David. So for all of you who just joined or already joined, or the audience, if you have any questions during presentation today, please type them into the chat box or the Q&A box in your Zoom control panel at the bottom or at the top, depending whether you're using your mobile phone or iPad or the laptop. And I will bring all the questions at the end of the presentations. If time permits, we will go through as much as we can. So now that's enough for me now. I'm sure you guys can't wait to hear what David have to share. So David, I will hand over the stage to you now.
Thank you, Grace. Thank you, everyone. Thanks for spending the time with me tonight. So with the next maybe 40 minutes to an hour, I want to share some deep thinking from myself with observing what's happening in the market, and hopefully that will help everyone here to understand the market better, to know what to do for the next step, to know how to protect yourself's hardworking result. As everyone knows, recently it's like the information exploding every day. not just about the banking crisis, the bad news, also about some very exciting news about AI, about ChatGPT. So with all of these informations, every day, new things keep coming out. For today's content, I actually keep changing every day because the information changing every day. I keep updating it. But tonight, we won't talk about too much about technology, AI. I would rather have another one. If I have the opportunity, I want to talk about it because it will affect everyone as well. But tonight we will focus on banking systems problem. All right. So it can be a disaster in the near future, or if we do the right thing, we can turn it into an opportunity for ourselves. All right, let's get into it. Before I start, I want to quickly introduce a little bit about Megawatt. Since we have lots of old friends here, I believe we do have a new friend joining us today as well. So Megawatt is one of the leading property agency in Sydney market, but Megawatt only focuses on selling brand new properties after plan, doing project marketing. But behind the Megawatt is not just Megawatt itself. So as a group company, we also, on the other hand, we're also doing property developments, property fund as well. Megawatt until today, actually it's already 13 years. Once we pass March, we already reaching 13 years. So to survive in this market for such a long time, it's not an easy thing. I believe everyone here can see lots of similar companies, they come and goes. But the reason for Megawatt can keep performing on the market for the last 13 years and with such a good result is because we have such a great team. The other reason is because we have our own value. We are very picky with the project we're selling. So I believe once you spend more time with our team, with Megawatt, you will realize the value of Megawatt. All right, that's enough about Megawatt. Let's get into the seminar today. Again, but today's all the contents is it's not an investment advice, just a share of my personal observations and thinking to support everyone here to understand the situation better and to support everyone also to think independently. A system then becomes too complex and highly coupled with inevitably collapse. So this is a very famous concept actually in software industry, in IT industry. Eric Raymond, who speak of this concept, is open source software pioneer. The reason today we can use so many free software, including the concept of the GitHubs, all from one of these key members, Eric Raymond. So this sentence describing actually initially was only describing the system potential system collapse happening in software industry, but later on people realized actually this concept can be fitting many industries, especially including our financial industry. Actually, nowadays, our financial industry is in a stage too complex and highly coupled. So from another point of view, we do have a very high risk to facing the system failure. That is a key reason, actually a core reason, why we're seeing all the bank collapse and the banking crisis happening right now. So let me do a quick summary regarding what's really happened recently. All right. So here you can see 3 banks. This is 3 banks from America, which all collapsed within only 5 days. I did a very simple timeline. On 8th of March, Silvergate announced they get into the bankruptcy procedure. Actually, it's a liquidation procedure. So Silvergate actually is one of few crypto focusing bank in America. They are not big, but actually they're quite unique, quite special. And on 10th of March, SVB, Silicon Valley Bank, got into the liquidation process and taken over by FDIC. So SVB is one of the largest bank actually in America. They are the 16th largest, and their specialty is focusing on startups. And the third one is, which happened last week, is 12th March, Signature Bank. Signature Bank is the 29th largest bank in America. They are not small either. And also they are one of the few banks which shows, being very friendly to cryptocurrency. And all these three banks, they went to bankrupt within 5 days. That's actually blows my mind. Before this happening, for all my career, I never thought I would see this happening in real life. Because we heard about bank runs, right? Deposit runs, we heard about a lot. But in Australia, we never see this. We never experienced. Also, in America, we think America should be the core financial center of the whole world. And America print money by themselves. How can America's bank get into this situation? Actually, it's all start from one sense, start from the Fed, the Central Bank of America, Fed. They start to increase interest. So when the interest is going up, when banks collecting money from all the depositors, from all their clients, they do have another pressure is how do they utilize the money? But during this period, since the interest is going higher and higher, American, if I memorize it correctly, the Fed has been increasing interest rate for already 9 times so far after COVID, and it still kept going. Right. So once the banks facing this pressure, they need to pay more interest to the depositors. They have to find a good way to utilize the cash sitting in their bank account. If they don't do it, they're going to lose money because the money is not free. Right? They have to pay depositors interest. But if the Fed keep increasing, the interest too fast, for the banks, the way for them to invest their money is getting more and more limited and more challenging, especially in this market due to the high interest rate. The market is not active as before. People before they are willing to, they have more confidence to borrow money. Now they change their mind because the interest rates are too high. So for the banks, it's hard for them to invest. And due to all the regulations, they can't do too risky investment neither. So use the money to buy bonds. It's become actually one of the best ways to invest their money for the banks. And all these three banks, especially for SVB and the Signature Bank, actually they were the good boys before, because they use a lot of their cash to buy the MBS, which is mortgage-backed security, also to buy lots of treasury bonds. But the problem is, for the MBS and the treasury bond, the liquidity is very low. So, and once when the Fed keep raising interest, the bond and the security bought before, the value changed, because now the Fed offering more interest than anyone else, than any of the bonds they issued before. So now the value of the bond, actually the price increased, but the value decreased. That's why they cause a book value decrease for all those banks. They lose money on the book. But that's only temporary, because once the bond getting mature, they can sell the bond, get their own their money back, plus every year they're collecting interest. So as long as they can hold the bond until it's getting mature, they won't lose money. But the most dangerous thing for the bank is during this period, before they can sell the bond, collect money back, if the depositors start to withdraw their money from the bank with a big volume, then the bank got issued, because majority of the money sitting in something as an asset, and they can't sell it quickly with the original price. So that's actually the core reason. When the depositor hear all the negative news from the bank, from the market, when SVB announced that they have 18 billion losses during the last year, they scared their clients, and the clients start to withdraw their money very fast and all together in one go. So that's caused the collapse of these banks. That's only a very quick and short summary for what's happening. So we can tell this is the banking system's failure because of what the Fed has done. But I don't think the pressure only happened to these three banks. Actually, majority of the small banks, they have even bigger pressure, because for their clients, they have less credit. The majority, depositor like myself, we trust the small banks less. That's why I think right now in America, there should be much more, the number of the banks who are facing the collapsing risks, the number should be much more than three of the banks. Right after Signature Bank collapse, actually this fear, keep expanding, keep affecting outside of American system. So last week, it's going to affect the European market as well. Credit Suisse. So I believe everyone here already know Credit Suisse already collapsed. But a little bit more background about Credit Suisse, in case some of you doesn't know the background. Now, Credit Suisse is actually the oldest bank, in Switzerland. It was founded in 1956, or that's 167 years history. By end of 2021, Credit Suisse has assets under management of 1.75 trillion US dollars. Okay, it's also part of the world top 30 banks known as GSS, globally systematically important banks, which means all these 30 banks, any of them, if they went into bankrupt or they collapse, it will affect the whole global financial system. It's very dangerous. That's why actually none of these 30 banks can be bankrupted. They have to be saved by the government, because that's the only way preventing the banking system failure. They are too important, too big to fall. So what's happening with Credit Suisse is not exactly, the collapse, the reason of collapsing is not exactly the same as the previous three American banks. I showed here a chart showing the price changes during the last 3 years for Credit Suisse. We can tell Credit Suisse has been involved in lots of scandals, bad news, and failed investments. So during the last 3 years, Credit Suisse already keep losing money for long term. But as we all know, Switzerland, they have a very good reputation of the banking system, because they keep in their clients' private information very well. For the last 100, 200 years, more than 100 years, 160 years, credit Switzerland banks to always doing things with one core principle. They protect their clients' privacy in the highest level. So no other government can touch any private information from their clients. But due to the pressure from USA, actually this reputation has been, has been destroyed, has been collapsed during the last 2-3 years. And credit, the banks in Switzerland, they've been forced to release their clients' private information to the outside the world, especially to Americans. That's actually, from my point of view, that's one core reason for the collapse of Credit Suisse. So it's not exactly the same as the banks in America, but the result is same. The damage is same. So Credit Suisse went off in a very fast pace, and it bring it bring the whole world start to questioning whether our banking system is a good one or bad one. And that can be a very important start of a new era of banking system. I will explain later. So after Credit Suisse, went off, the bad news keep popping up in European market. So I think most recently, for the last couple of days, maybe some of you already heard, is the Germany bank, the Deutsche Bank. So what's happened with Deutsche Bank is last Friday, the share price of Deutsche Bank has been tumbling for 15%. And on the market, the credit default swaps price of Deutsche Bank got a new high since 2018. What is this credit default swaps? We can call it CDS. It's actually kind of insurance for the banks. So if the price goes high, which means the banks need to pay more to the insurance company to buy the insurance for themselves. That's why if the high price of insurance means higher risk of the banks who were protected by the insurance. So which shows the less confidence showed to the banks. But Deutsche Bank is also one bank, is too big to fall. It's the 22nd largest in the world, and the size of Deutsche Bank is twice of Credit Suisse and half the size of Bank of America, 7 times bigger than SVB, Silicon Valley Bank. Even with such a major bank, we're still seeing the market is losing confidence to it. All these things has happened in such a short period. It's brain panics, it's brain chaos. But what about ourselves? Should we be panicked? That's one main question I wanted to ask and try to answer it. All this bad news is already bad enough, but from my point of view, still it can be under control. Right? Let me show you why. After Silvergate went to liquidation, right now it's already liquidated. All the deposit, had been guaranteed by SDIC, and some big institutions already bought the major shares of Silvergate. The major institutions including BlackRock's, the big ones. So right now, no one really, beside the shareholders of Silvergate, the majority of people have been protected. For Silicon Valley banks, what's just happened is, first of all, FDIC promised all the deposit will be fully repaid. And also right now, the solution for SVB is FDIC will holding 90 billion of their assets. The rest of 72 billion been sold to the first season banks. But first FCB, the first season banks, only paid a very small price, which is $16.7 billion to buy 72 billion, assets. It's a great deal. That's why after FCB announced the news, and their share price increased all of a sudden in one day, increased 30%. 30%. So for SVB, beside the shareholders, the employees, the founders, majority of people has been protected as well. Signature Bank, quite similar. So it's been right now the bank has been a significant portion of their asset has been purchased by the NYCB, New York Community Bank, and with a very cheap price, less than 10% price. And FDIC is holding a major amount of the assets, which is $72 billion, worth of $72 billion. Majority of the assets holding by SDIC is a deposit from the bank's clients, from the depositors. And their responsibility is gonna make sure those monies will be safe. That's why they hold it. So from my point of view, even with this bad news, right now the American banking system, the Fed, the treasuries, they still being able to, still being able to holding the sustainability, the foundation of the system. So they make sure not many normal people have been really hurt by this banking, collapse. But what's happened with Credit Suisse? It's just happened 2 days ago. UBS actually bought all the share with 3.2 billion worth of dollars, their own share. So the purchase for Credit Suisse is not a money transaction. It's all share transaction. So they swap share. So UBS used its own share to exchange Credit Suisse all the shares. But on the other hand, it's a very good deal for UBS because they use one UBS share for every 22.48 Credit Suisse shares. Or you can tell that's a big discount, but even with such a good, very attractive deal, UBS still actually very scared to take over Credit Suisse. The reason I already explained for the last certain period, Credit Suisse, all the assets is like a black hole. No one really understands what's the true, dangerous or the true structure of those assets. This can be a bound, a timing bound for UBS as well. But all these deals has been forced, not by UBS, it's by the government of Switzerland. Right? So actually, it's the government that forced this deal to be made. The reason I already explained, because these banks are too big to fall, so they have to save it to make sure the collapse won't affect the other side of the system. So right now, more people hurt by Credit Suisse, because when the government making this deal happen, they made some very bold moves. So first of all, they changed the law. If you have a background of commercial, if you learned laws in uni or in previous study time, you should know for a company, so the how do I describe it? The priority of the beneficiaries should be start from the first, the one holding the most priorities, it should be the lenders, right? The people who lend money to the company. And the second one is the shareholders, right? But when the Switzerland making the deal happen, force UBS to buy Credit Suisse, they know one thing: the shareholders will never allow this deal to be happen, because they have to pay off their debt first. They have to pay the people who borrow money to lend money to them first, and then they can think about themselves. So the government, for the purpose for the government to make this deal happen, they change the law in a couple hours. They tell the shareholders of Credit Suisse, you don't worry about your, your debt holders. Don't worry about the people who lend the money. We will write off this money. So all of a sudden, 170 billion of the debts to Credit Suisse have been written off. And majority of these lenders is from Asian market and from all outside of Switzerland. So that's one key move to make this deal happen. But to make it happen, the government actually changed the law. All right. So when I know all these facts, I start to doubt, what kind of system we are really sitting in. The government can do things out our imagination, which I can never imagine before this happened. And that's, I think, bring the whole question, the big question mark from everyone in the system to questioning, are we having the right system or not? So we talk about Americans, talk about Europe. Let's have a quick look about ourselves, Australia. The first question I would ask is Australian banking system safer? So quick answer, yes, I think it is. Right. There are a couple of reasons. I will list a couple of main reasons first. The first one is we got a very good watchdog. Right? Is the APRA, we call it APRA. Right? I think everyone, no one really liked APRA before this point of time, because we all know the whole Australian banking system has been, thoroughly reviewed and forced to regulate it during the last, since 2008, during the last 10 years. And myself as an investor, I experienced it's getting more and more difficult to borrow money from the bank, because the bank got more and more regulations, all due to this organization called APRA. All right. So no one really liked them before. But right now, if we look at APRA, we just realize how important, for the last 5 to 10 years, how important APRA has done to our banking system. So actually, Australian banking system is using the world's strictest protocols. And during the last 4-5 years, all our Australian banks were forced to participate in an extensive operation review since 2019 is operated by APRA. And also, I think from 2008, the government has a government deposit guarantee for $250,000, which means if you put your money in one bank, if it's within $250,000, the government will guarantee it for you. So it doesn't matter what's happened with the bank, the government will get the money back to you. And the same, they have same policy in America as well. It's all, I think, it starts from 2008, the last financial crisis. Also, another very key reason is in Australia, majority our mortgages, we're talking about majority residential housing mortgages, they are using variable rates or very short-term fixed rates. We're talking about like 2-3 years fixed rate. If you want to use fixed rates, the bank only give you 2-3 years. But majority of people is using variable rates. But in USA, most of the banks, most of these mortgages, they are using 20 to 30 years long-term fixed rate. So before we thinking that's insane, because for the borrowers, if they get into the market, they borrow the money early enough in a very low interest market, they can lock in their their interest rate for 20 to 30 years. So for the borrowers, it's a very good policy, but for the banks, on the other hand, it's not that good, because all the borrowers, they lock in their interest rate. So when the market changing, when the price of the money changing, for the banks, they don't really have much room to change. They still can only collect very limited interest from those borrowers. On the other hand, they have to pay a very high interest, to the depositors. So in that system, in American banking situation, it's very easy for the bank to lose their money from that point of view. But in Australia, our bank are sitting in a much better position, only due to this very unique reason. Also, Australian banks only offer very limited LVR leverage. As an individual, we can only borrow up to 80%. If we want to borrow anything more, we need to buy an insurance to make sure the insurance company will protect the bank. It's called mortgage insurance. And so the bank only expose themselves to 80% LVR for individuals only for residential properties. And for commercials or for other purposes like development loan, the commercial property owners or developers, they can only borrow up to like 50 to 60 maximum, the LVR, 50 to 60%. So the bank always been very conservative in Australia. All those unique reasons is making sure Australian banking system is is much more safer than outside the world. So from my point of view, even we don't really have a perfect banking system, nothing perfect, but we have much better system. The reason it's not perfect is because actually all the banking system from each country is all linked together, because our money is linked together. In Australia, 25% of the foreign investment is coming from USA, 25%. But this 25%, if USA, the banking system is collapsing, I believe lots of this investment will be affected. So on the other hand, it can affect Australian market, can affect our banking system easily. So we still need to be really careful. All right, let's step one step further. All right, what's really happened behind the scene? I probably spent a bit too much time to introduce the bank. Now let's get into the next stage. What's really happened behind the scenes? So this chart is showing the Federal Reserve, Fed, their total assets. All right. So the Fed's total assets, which means how much money they've been printed, they've been released to the market. We can tell there are two big jumps. For the history, there are two big jumps during the history. The first one happened in 2008. That's, as we all know, that's the last financial crisis. So to save the whole economy from the crisis, the Fed have to print lots of money, release to the market, and the volume of their asset to the volume double. But then once the COVID happened, this happened again, but it's happened in a more dramatic way. So when the COVID just hit, the asset size is roughly 4 trillion. But now at the peak in 2022, early 2022, the total assets is reached almost 9 trillion. So which means during the 2 years of COVID period, Fed released same money amount floating in the market. So they doubled the size of money in the market. And that is the core reason causing all the inflations, all the problems. But today, I want to talk about something different. Let's focus on the recent 1 or 2 years. We all know for the Fed, for the American government to control the inflation, what they've done. So they did called quantitative QT, quantitative tightening. So one hand, they keep increase the interest. The other hand, they try to cut the side of their balance sheet, cut the side of their total asset volume. So they try to retrieve the money they released before, right? And it actually started working. Right? From mid of 2022, the size of this balance sheet keep shrinking, and from almost 9 trillion to 8.35 trillion. But just for the last 2 months, right? 1 or 2 months, actually just for the last 1 or 2 months, in the period, all the banking crisis period, the Fed trying to save the banks from banking crisis. They've been forced themselves to start to use extra money to help these banks. So all the money they retrieve back, now they need to release back to the market again. That's what we're seeing here. The size of this asset, the balance sheet, all of a sudden increased back to 8.7 trillion dollars. So which means all the efforts the Fed is using to control inflation, right? To control the hit of the market. All the efforts they've done, now they lost more than half the efforts during the last couple of months. This actually is very scary, right? Because on the surface, US government, the Fed still telling everyone the inflation is under control. But from this chart, we can easily tell it's not really, it's under control. Actually, it's getting back. I believe, very soon, maybe in the next 2, 3, even 5 months, we will start to feeling, the fear of inflation again. The inflation will not be under control. It will be getting worse and worse. Hopefully, the hyperinflation won't happen. So what is the true problem? What's the true problem of this chaos? So with all the questions actually I've been keep asking, I've been keep mentioning, with all the people, they start questioning our system, questioning the bank system, questioning the financial system. Actually, it all come from one key reason, which is the current currency system is called a fiat currency. Or fiat currency is not something have the true value. The currency we're holding now is only backed up by the credit from our government. So it's backed up by law, backed up by the enforce of law. Then it's not back up anything but true value. Right? That's why when the central bank of the whole world, which is the Fed, when is keep printing lots of money, release to the market in a very dramatic way, the fiat currencies, the weakness has been exposed, has been enlarged in a very short period. And that's caused all the issues happening now. And when the central bank Fed try to control it again, it shows people the back spine of this system is so easy to change. They can, when they need to print money, they can easily print money. When they want to retrieve money, they can retrieve money. But it's damaging the whole world. Let me explain in a very, very simple way. During the COVID period, the reason for the Fed to keep printing more money is because during that period, everyone's in difficulties, right? Everyone have limitations to work more hours, so they need more income. And to keep the whole system floating, we need more stimulating, more liquidations, more liquidities in the system. So Fed released double-sided the whole money in the world, and this money went out of American and buying all the assets all over the world in a very cheap price because we are during the COVID crisis. After that, once Fed trying to control the money, they try to retrieve the money again. They start to increase the interest rate. They're paying more interest than before. Then the money starts thinking, actually, if I give the money back to the Fed, I can earn more than 4%, 5%, very stable, guaranteed income from Fed. That's a very good deal for this large money, for these large institutions. So that's the point they sell their asset when they purchase cheaper and sell in a better price, and then put the money back to American market. So through that way, we can tell Americans actually, is cutting the benefit from all over the world and benefit themselves in the system. All right. So that's one way to show the whole world. Maybe we need to re-look at the whole system. Should we keep trusting Fed to control the money for the whole world? Now, that's why I'm feeling this can be a new era. New era maybe just started. All right. So what's the future? What's the future? From my point of view, this is very, I think, the bold prediction for the world. It's may not going to happen very quick. It can be happen in 5 to 10 years, even 10 to 20 years. But I think it's already on the trend. It's going to happen, just a problem of time. So the fiat currencies, the system fiat currency is collapsing, which is causing all the problems right now we're seeing it. And the future currency system need to be commodity currency, all right? So it's kind of going backwards because before fiat currency, our currency was commodity currency. We're using silvers and gold to value our money. So I'm showing two American dollars, which ones before the fiat currency kicked in. We can see on the nose, the nose is a legal this is a fiat currency. On the right hand, it shows it's a $1 silver dollar. All right. So this dollar's value is backed up by silver. But after 1971, after the Americans start to adopt fiat currency, the notes changed. It's saying this note is legal tender. All right. It's not backed up by any true value. It's just a legal tender. It's a legal enforce. And but the future commodity currency is, the concept will be much broader. It's not just limited to gold or silver. It's actually, it will be, I think, defined by all the valuable commodities in the energies, in oils, even labors, technologies, informations, everything you can think about have true value is the country can offer to other countries, other side of the world. That will be all the backbone of the country's own currency. All right. I'm not sure if I described clear enough, but what I'm trying to say is the future currency system will be backed by true value rather than just government's law enforced. So within the next 5, 10, or 20 years, if this really happened, I think it's already happened. If this really been accomplished, we'll see another change for our world. Is our world will be changed from a unipolar world into a multipolar world, and then back into the globalism. All right, we're calling our world before COVID is globalism world. Actually, it's not the real globalism because it's actually still a unipolar world. What is unipolar world? It's one very strong power control the whole world. So right now, that power is American, right? But once American, if the fiat currency system collapses, once American dollars losing their power to control the whole world financial system, then the unipolar world will be changing into multipolar world. So the powers who can affect the world will be not just one power, it will be multiple powers. Right? It can be China, it can be Middle East, all those countries who control lots of energies, oils, petrols, and it can be other countries who control, same as Australia. We Australia holding, we have so many mines, important mining resources. That's all will back up our currency's value. So what I'm trying to say is, along with the evolution of the currency system, our world actually will start to changing, right? So we will not just say a world is guarded by one place, by one power, which is America. It will be a world more balanced world. It will be protected by multi-powers together. And maybe in 50 or another 100 years, we'll get into the true globalism. Everyone is on the equal level, share the resource, share the knowledge. That's the only way, what I can see for our, for human beings to keep involving ourselves. Maybe that's already too far off the track of the topic today, but that's my thought. If we pull back, or we dip a little bit deeper, we ask another question: what should we do with our money? That's actually the key question for today, for everyone here. What should we do with your own money in the current environment? We know the bank system is start to changing, start to collapsing, and the money system, the currency system is start to evolving. What should we do with our money? To answer this question, I think the easiest way is to think about what are the most smart people to, what are the richest people, what are they doing? Right? So actually, the one thing I forgot to mention is all three banks which collapsed in America, which is SVB, Silvergate, and Signature Bank, including the banks who just collapsed as Credit Suisse. Majority of their clients, not normal people, right? And for example, SVB, their client is majority of companies and startups. Lots of very successful startups, they worth billions of dollars. They are the clients of SVB. Also for Credit Suisse, their clients are majority rich people. As a normal people, it's very hard to become to a client of Credit Suisse. They actually only service the richest group of people in the world. Right? I heard from my friend, so they're saying they told me Credit Suisse charging very high fees for accounts. If you do any transactions, they charge like 5 to 7 times, more than other banks. From that way, they try to prevent the normal people using their service. Right? Also, if you want to use their service, you have to have a minimum deposit. It's like $500,000, even a couple $1 million. Right? So these banks actually not service normal people. They service the most powerful or richest people in the world. But now these banks start collapsing. Think about what would these smart people, what these rich people would they do? They will withdraw the money. They will have to find a better way to secure the money, right? So leave the money in the bank or investment the money. That's the simple question I believe those people asking themselves. And I don't think leave the money in the bank is a good answer for them, because they already experienced the bank start to collapsing. Right? So they will use their money to, in some way of investment, to make sure the value of their money will keep increasing. Right? So they may use their money to buy all the valuable commodities. They may use their money to buy other form of assets to make sure the value of the money will be there. And from another hand, I believe this will actually make our inflation problem even worse. Because before this money sitting in the bank, not affecting our system, not affecting the commodity price. But now, since all this money coming out already, so they will make the inflation even worse. But us, as a normal people, what can we do? Should we put our money in the bank, waiting for inflation bit by bit, absorbing the value of our money, or should we invest our money? This is a question I want to answer with the rest of the seminar. All right. The simple answer, I think, for us who live in Australia, right, the best answer for us is the Sydney property market. Let me show you a couple of charts to prove why I'm thinking Sydney property market is the answer for that question. This three chart shows in the history of our world, or when all the pandemic happens, how good or how bad the financial system performs. Okay, this is a share the stock price that keeps fluctuating during all the crises happen. Also, the second chart is showing how the financial system perform, how the stocks performs during all the financial crises. But on the other hand, it shows the price change of the median property price in Sydney. All right. So we can tell if you compare with the price change with the stocks, the global stocks, all the Hong Kong stocks, we can easily tell it's a much more stable market. Even when the bad things happen, when the crisis happen, the market only change a bit, get a small adjustment and come back quickly. And same thing happened in the COVID period. Right. So that's the fundamental reason why I'm thinking the Sydney property market, Australian property market, is the key answer for that question. So for now, we actually should not put the money in the bank. We should actually try to invest money somewhere. And the best way to go is Australian property market. Right. But most of people, I think most of you would ask, how can we invest in property, especially when right now the interest rate is so high? Everyone knows the interest rate increased a lot for the last bit more than half years. But the interest rate may keep increasing. But should we still be brave enough to put our money in the property market to bear the very high interest? Or should we, leave the money in the bank to leave it to the inflation, to let inflation devalue our money? Right. So let's try to find the answer from history again. All right. So this chart showing is the whole record of our home loan rate in Australia. Right. And we can tell right start from 1959, the rate was 5%. Actually, it's quite similar as today. Right? If we borrow money right now from the bank, if you borrow money for your own unoccupied properties, it roughly is 5 to 5.5% right now. Right. And during the whole history, with the record, we can see there are certain periods we have the rate increase dramatically. One is like 1974 to 1975. The other one's 1979 to 1981. There are a couple periods. I'm picking up this period. I'm trying to do one thing. I'm trying to find the period when the interest rate increased dramatically during the history and compare the house price change, the property price change during that period. Then we may find some trend whether the interest rate change will affect our property market and what's the effect. Right? So I'm using the data from ABS to track in the property price in the capital cities. Since this figure I'm using is mainly focused on, I'm using the Sydney property market price to compare. Right? So during this all the majority, the record history of home loan rate, I picked up 5 periods. We had dramatic interest increase. Okay, this 5 period is 1974, 1975, 79 to 83, 84 to 90, 2002 to 2008, and 2009 to 2011. So that's the 5 period when got the most dramatic interest increase. All right, and the interest been changed a lot during that period. The first period is 3.5%, 4.5, 5.5, 2.5. It's all happened in short period. And the property price change in Sydney, I picked up from the ABS system, and here is the summary. All right. So during each increase interest rate period, our property price in Sydney changed in this way. During 1974 to 1975, the interest rate increased 3.5%, but our property price increased 14.3%. 79 to 83, interest rate increased 4.5%, property price changed 52.8%. 84 to 90, interest rate increased 5.5, property price more than double. And 2002 to 2008, rate changed 3.5, property price changed 23.5, which is an increase again. So 9 to 11, property price increase again. All right. So from the history, none of the period during the interest rate increase, we got a property price decrease. Actually, every single period, we got a dramatic property price increase. All right. And I believe the history can clearly tell us a trend here, which is the high interest rate doesn't really affect the market, property market, in a fairly mid to long term. Maybe for a very short term, it will affect the confidence of the market, but that's only going to be for short term. In the end of the day, it will actually make the property market increase. It's actually not difficult to understand, right? Because in every single period, when the money getting more expensive, so the government, they're gonna do the same thing, or just like what's happening in the COVID period. The government has to, bit by bit, increasing the money, the amount of money in the market. All right. So once they increase the total volume of the money in the market, so the everything else is getting more expensive because the volume of the commodity, the volume of the total assets in the world not going to change that fast. That's why, when the money the volume of the total money getting bigger and bigger in a short period, so we will see all the assets in the price will increase dramatically. All right. And I think the history will repeat again. All right. And also, on the other hand, so there is another true crisis actually happening in our property market. I'm showing 3 pictures here. I think maybe some of you already experienced. All right. So these people lining up to inspect one single, the 3 group of people, each group inspect one single rental property in Sydney. So people are fighting to get a property to rent a property to live in. So the true crisis happening now is the rental crisis right now in our market. And what I heard is, in some certain suburbs in Sydney, for example, in Zetland and Green Square, some 2 bedrooms already rent up to $2,000 per week, which is crazy. But behind the rental crisis, the true reason to cause this rental crisis is another crisis, or it's a property supply crisis in our market. Because we have such a low volume property supply, that's why right now people have to fight to find property to live in. All right. So if you look at this right side, the chart, right? So we can tell since the COVID happened in 2020, the dwelling approvals from the government has been dramatically decreased. But dwelling approvals will affect the market in the long run. So the how the market work is once the government approves the development of dwelling, development from the developer, the developer need to find all the resources, sign up builders, then start the construction, and start to use money to push the project forward. And usually for normal in the 100 to 200 size apartments, and it's going to take like 2-3 years minimum to build. So the approvals, the dwelling approvals will affect our market at least for 2 to 3 years. At least for 2 to 3 years. But during the whole COVID period for the last 3 years, the approval is keep decreasing. And this another chart is issued by ABS and HIA. HIA is the House Institution Associations Australia. So it's one main institutions for the house industry. So it shows the dwelling, they are forecasting the future dwelling commencement from mid of 2021. And the forecasting is the dwelling commencement, the construction commencement will dramatically decrease as well, because I think the answer is simple, because there are no approvals. So of course, developer cannot build any more properties. Right? So that's another step in, cause our residential vacancy rate dramatically dropped during the last couple of years. Because once the COVID, getting into the last stage, the people started coming back to our market, overseas students, overseas workers, all the people who left Australia and come back again. So that's called the big demand for the residential properties, especially for the rental market. But due to their very limited commitment, very limited approvals. So right now the supply of the market is very, very limited. That's caused the vacancy rate is dropping right now. So this is the current vacancy rate. In the capital cities, it's only 1.4%. In Sydney and Melbourne, it's all below 1%. Okay, if the vacancy rate is below than 3%, it's telling the government right now we are really lack of properties on the market. But now it's below even 1% Sydney, which actually is scary. So the government actually need to find a harder way, find a very efficient way to push back the supply. Otherwise, we will see this crisis is getting worse, and which will actually damage our society even more than the banking crisis from outside the world. And this is the forecast for Sydney's future supply to demand. And the household formation is represent the demand from Sydney market. And supply additions is represent the future supply of Sydney. We can tell for the next 10 years, or it's almost next 10 years, Sydney market will be kept in the situation as insufficient supply, right? And will getting worse during 2026-27, and getting slightly better from that point. But for the next 10 years, our market will be lack of property. And even worse, the construction market is in a very dark period. All the builders is right now, lots of major builders get into bankruptcy in the market. The reason is it's very complicated, but majority is because during the COVID period, everything's getting more expensive. The inflation caused a dramatic cost increase for the builders, but the builders, they signed their contract before this dramatic increase happening. So they signed a very low price contract price, construction price to the developer, and now they have to bear the price increase, the inflation from the market. That's why it's very difficult for them to survive. They rather go bankrupt, and because if they keep delivering the project, they will lose more money. That's why lots of the builders, they choose to go to bankrupt or choose to be, get into the liquidation process rather than keep going with their own business, because every single day they're losing money. So with all of this, there are not much really solutions for the construction industry in Sydney. There's only one solution, which is the significant increase of construction cost. We have to face the fact is the builders, they have to charge more to make their business feasible and then to survive. Right? So with all these facts, what's the consequence? What is the consequence of all the facts I just gave you all? I think the consequence is clear and simple, which is the property price in Sydney or in Australia will keep going up and up. Right? So I know there are lots of negative news about the property price, about the property market right now, but majority medias, they spread the news without really looking into the market, without really understanding the market. So from my understanding, from what we just discussed, the chance for Australian property, the price going down or collapse is zero. The only one way to go is going up and up. So for the people who already have properties, that's good news. And for the people who want to buy property, that may be not good news. But as Warren Buffett said, bad news is an investor's best friend, all right? Because we always can find the opportunity from the bad news. So this chart is showing right now in Sydney market, there's a very interesting fact. The fact is, during the COVID period, the price gap between house and apartment is getting larger and larger. So right now, we are sitting in the price gap around 50%. And during the history, this gap should be sitting around between 20 to 30%, but now it's sitting around 50%, even with the current price adjustment for the housing price in Sydney, we still have a big gap because the apartment price hasn't been really changed much. Okay, but with all the facts we know from today, the inflation is going to get worse and worse. The construction costs getting higher and higher. So for property price, especially apartment price, it has to be adjusted very quickly and very soon. And I think the government will help the developers and the builders to adjust the price. They will find a way to push up the apartment price to make sure developers, builders can survive. So I think right now, actually, we are having a very good window time to think about buying apartments as an investment. If you never thought about it, if you were one of the people who thinking the best investment in property market is the house only, I think you really should take a step backwards to rethink all the facts we just been discussed. I do believe next to 5 years, even 5 to 10 years, 3 to 5 years, maybe it doesn't need to be wait for 10 years, 3 to 5 years will be the golden time for apartment investment. So at the last, I want to share this famous sentence from Winston Churchill. He said, never let a good crisis go to waste. All right. So right now we are in a very bad period. We experience all kinds of different crises, but we can still finding opportunities from this crisis, all these crises. The most important thing is we need to do it rather than just watch it, let the opportunity go. All right, so that's all from me today. Sorry about the overtime. Just got a lot of information I want to share, but the time is quite limited. So before we get into the Q&A, I just want to show you our great team in Megawatt. So Megawatt has a great multi language team to service every clients, service the market, and everyone is professional, also passionate about the job they're doing, about the career we're doing now. So hopefully everyone here, if you start to think into doing investment in property, please find a the consultant from Megawatt and start to talk. Right. So our team getting all the good reviews from our clients, and we appreciate the support from our clients. If any of the old clients was listening now, so really appreciate your help, your trust, and your support. All right. Now I will hand over to Grace and get into.
I'm here.
Thank you.
Thank you very much, David. It was really insightful, full of informations that really open up my eyes as well. So we do have a few questions here. Thank you very much for utilizing the Q&A chat box in the Zoom function. So the first questions, David, you have pretty much answered it already. So that person is really happy with that. So the first question was, how will interest rate affect the property prices? There are mixed market reactions, some areas to have strong demands and even increased prices while others are falling. So it is really confusing. It's like, oh, the interest rate supposed to make the property price goes down, but how come it's going up? So the answer, David already provided, it's about supply and demand. Thank you. The second question, David, is where do you see the buyers coming from? And how can borrowers secure a loan? So I understand that it may not be the theme of today's webinar. Maybe you can give a short answer for this. Like, where do you see the buyers coming from given the interest rate? Yeah.
All right. I still want to address the first question a little bit. I already explained in the seminar, but I want to say, before you decide to buy property, if you decide to buy, you have to make sure your cash flow is healthy enough to support your future down payment. All right. So if you're thinking your cash flow is quite tight, maybe it's not a good timing for you to buy a finished product, a finished property or a second-hand property, because once you bought it, you need to start to repay the mortgage, right? But there's always an option, right? You can think about to buy as a plan. If you're confident about the future jobs or about the future incomes, maybe postpone this repayment for another 2-3 years through after plan. But from after plan, you can lock in the price right now. Right, you can secure the future appreciations of the price increase for apartments or for the property you want to buy, but only start to repay the loan in 2-3 years time. Maybe that's another good option, but you have to make sure you're capable to support your loan. That's very important. Right? So you need to check and check again to make sure your cash flow is healthy now. All right. So where the buyers coming from? How can borrower secure a loan? Or the buyers right now? Actually, the buyers coming from everywhere. Since we experience, we talking to buyers every day, right? As the business nature of business and Megawatt, our team talking to different group of buyers. We realize it's not just we're seeing the local buyers quite active right now, the downsizers. And the buyer who actually holds their demand for the last 3 years, because the last 3 years of the COVID period, they didn't really push the button, but now they start to thinking of it. And they have their true demand from the families. During 3 years, the big change can happen to a family. Kids can grow up, they can have new kids or newborn babies. So lots of families change. They have to upgrade their property or they have to buy new properties. So that's one group of the buyers. The other group of buyers is the overseas buyers. And overseas buyers, including the overseas investors. Also, the people who come back from overseas to work in Australia or to study in Australia, since it's so hard for them to to rent a property right now. So some of them already, if they have enough cash, if they have enough financial support from their families, they will choose, and they are willing to choose to buy a property rather than rent a property right now. So that's, I think, the main groups, the sort of buyers. And to secure a loan, so right now I understand it's quite difficult to secure loans for some people, especially for the people because the increase in interest rate, your borrowing power actually is getting smaller, because when the bank considering future interest payment, they will decrease your borrowing power because you need to spend more money, more cash flow to service the loan. But what I'm thinking is, you still have your options, right? Lots of people, they have very limited borrowing power is because they are borrowing money to buy their owner-occupied properties. When you buy owner-occupying properties, the bank will only consider your only income source is your salaries, nothing else, if you don't have any other income source. So with what's happening now in the market, with increased interest, that will very much affect your borrowing power. But if you're borrowing money to buy investment property, then it's a different story, because the bank not only consider your income from your jobs, also they will consider the income of the rental income. And since right now the market rent is going up in a very fast pace, so that rental income will be a very big support for your future service capabilities, which will make sure the bank give you a much more stronger borrowing power than just buying a property for owner occupying. So if you change your mind, maybe start to thinking buy an investment property rather than a self-living property, you may have a good chance to secure the loan. All right. And that's not a bad thing. Actually, for myself, I started buying my first property and my second property both as the investment property, and I choose to rent to live and an investment in property. One thing is I secure the price of the property. The other thing is I can use the negative guarantee a bit more, rather than leave the property in by myself. All right, so that's my answer to a question.
Thank you very much, David. Let's go to the next question. I can see, so the next question is, I see other media saying that interest rate increasing and there are a huge amount of borrowers who fixed their interest rate 2 years ago and is now due to change to variable rates, and there will be a lot of people starting to sell property because they just can't do their repayment this year and led to property price decrease. What would be your view on this, David?
Look, this is a reasonable logic, right? Once the rates going high, some people will be forced to sell their property. But we have to rethink of this logic in a more practical scenario. In Australia, majority of the household, actually more than 70% of the household who bought their property is only holding one single property. All right. So 70% of the property owners in this market in Australia, they only own one single property. All right. So actually, doesn't matter how the market change. If they sell their property, they have to find something else to live in. They need to rent, or they need to find another way to buy a new one, right? So in our real world, it's actually going to be very limited number of the people who are gonna sell their property due to the high interest rate, and only because that's the only property they have for the whole family. And on the other hand, actually, right now, Australia has one of the lowest unemployment rate in the world. So our economy is quite healthy right now, and we are actually lack of laborers, not a lack of jobs. We have much more jobs than the laborers on the market. So everyone who are willing to work in this market, they can get the job, they can get the proper job, and their salaries actually become to much higher. Right? So doesn't matter how the medium try to make it more dramatic. The fact is, in Australia, people have one of the strongest supporting capability for their mortgage in the world. Australia's average income is ranked right now number 2 in the world, just a little bit behind the Zurich. The first one, the most income coming from city is Zurich. The second one is Sydney, actually. So we have one hand, we have strong income for everyone. On the other hand, most people only holding one property. So they're really not, I think the scenario describing your question is just maybe one logic thinking from some media, but it's not that practical. It's not really going to happen. And it's been proved many times already during all the crises happened in this market. Actually, only very small number of people being forced to sell their property. And during these cases, it's not because they can't afford the interest rate. It's only because the maybe divorces or the people getting too old and pass by. And don't forget about one fact: our interest rate was once higher as 17%. Look at here. It's 17% high during 1990s. But during that time, the property price still increased, right? If our market can survive such a high interest rate in the history, right now we are only sitting actually even below the average interest rate in the history. The average interest rate in the history should be around like 7 to 8%. We're now still below this average rate. So I don't think many people are going to be forced to sell their property at all. All right. So that's my answer.
Thank you very much, David. We have one more question here. So it says, how are changing demographic and lifestyle trends affect the demand for property in Australia? And what impact might this have on the property market and the banking industry in the future?
Give me a second. Let me find the screen, the Q&A screen. Yep. The lifestyle trend affecting the demand and what impact? This is a very good question, Will. So, very interestingly, Meg was already finding people and buyers in Sydney market. The appetite, the trend for them to choose new properties already changed. I think before COVID, people tend to buy properties which is cheaper properties or more in a certain suburb. Majority of people always tend to choose cheaper property rather than more expensive properties. But after COVID, we just realized right now, literally majority buyer, every single buyer, especially in certain suburbs like Castle Hill or Upper North Shore, they start to only put their focus on the quality of the property rather than the price of properties. So people actually get less price sensitive and the more quality and the design sensitive of the properties. So I think the lifestyle, the trend of lifestyle, they change. People start to realize they do need to spend more time in the home. in their own properties. So they are willing to spend more money to buy a better designed environment for the family or for themselves, rather than live in the normal designed apartment or low quality apartment, even it's cheaper. So I think that's the trend, and which is affecting the market right now, and which I think giving developer more confidence to do better quality products as well in this market. So
Yep. So
yeah,
I can
I think
see.
yeah,
Sorry.
along with the banking industry, they already start to tell this trend. I think they will give a better quality property a more justification in the valuation, rather like before they purely rely on the track record, the price of the property was just sold in the market. They ignore the quality design of the property and the valuation. So, but from I think this point, when banks doing valuation, they will pay more attention to the design, the quality, and details of the property to be justified in their valuation. Yeah.
Thank you, David. Definitely quality property is the way to go. The next question, we might be able to combine the last two, is
Sure.
that I see my friends purchase house and land that increase value a lot. I do have a few apartments as investment properties, but price does not increase too much. Should I sell the apartment and then buy house and land? Or where do you suggest is the best investment at the moment? Apartment in Sydney, house interstate? Where do you suggest?
Okay. What's happened to the house market, especially during the last 3 years, already explained in the seminar, which create the big gap right now between the house price and the apartment price. The fact is, during the last even 5 years, our apartment price didn't really increase much, right? But on the other hand, the property house price increased a lot. But another fact is, in majority suburbs, especially in Sydney and Melbourne, the affordability for the local residents, to afford buying houses is getting very limited. So the house price is too high to afford, in a sense, for majority suburbs. So that's why we are actually starting to see the price already start to shake a bit, but I don't think it's going to drop. I don't think it's going to drop. But on the other hand, it won't increase as many as before, as fast as before. It won't. For the house price already reach a certain point, it need a certain time period, a pretty long time period, for the residents, for the people to catch up their income to afford new price hike again for the house price. But for property, for apartments, it's different. All right. For apartments, for the last 5 years, price literally didn't change much for Sydney market, at least. I believe same as the Melbourne market. And we know the construction cost, everything else, labors, everything is getting more expensive. So, but apartments is the only solution. Apartments is the only solution for the government to resolve this housing supply crisis. So more apartment has to be built in the near future to make sure our society have enough space to live in. And that's why I'm thinking in the future build apartments, the price will be dramatically increased for sure, because the cost of everything. And for the builders, for the developers, they need to make profit, they need to make money, right? Without healthy profit, even the bank won't support developer to build their projects. So from that point of view, I believe the future price of new apartments will keep increasing and increase a lot. But for your second-hand apartments, you need to really, I think, spend a bit time to analysis by yourself whether it's sitting in a good location, whether design, details, everything, the quality is good enough. If it's not a very good apartments in terms of building qualities, designs, everything, maybe it's you can think about to swap into a future build apartments, before the price start to increase in a fast pace. Swap it into an after plan even. That's maybe a good, a better option to keep all the second-hand apartments if it's not in a good location, if it's a quality have potential problems. All right, so that's my suggestion. And so at this moment, personally, I do believe apartments better than house. Apartments and house, they're sitting in the different categories. Apartments offering much better, more cash flow, right? So if you don't want to bear a very heavy burden from your future mortgage, apartment will give you a better experience, a less burden from that point of view, because the rental return is much higher than house. Right now in Sydney, we're having 3.5 to 4% rental return. But for house, we only can achieve roughly 2%. Some suburb even 1 to 1.5% rental return. So you need to evaluate your service ability to decide which category you're going. So for most of the normal people like myself, if you want to diversify investment, if you want to have less burden of the future investment, I think apartment right now is a better choice, because the price being very well maintained for 5 years. I think right now it's getting the point it will start to pick up very soon. Thank you.
Thank you, David. Thank you very much for your insights. It's amazing insight. And thank you everyone for your questions. We're just going to wrap up the Q&A here. And just wanted to let everyone know that this webinar has also been recorded. So if you'd like to revisit David's presentation, you can view them in our Megawatt channel in YouTube. So we will be uploading this video onto our YouTube channel. So before we wrap up, so I just wanted to share with you that the quote. So this famous quote is actually what we believe in. So the right time to invest is now. And our ideal lifestyle is not created by imagination, and it is designed through financial tools and knowledge. And today, I believe all of us has already in 50% in advance, because we have the right knowledge also to understand about this market. So I think through David's presentation, I think it's very important point that came through his presentation is that sometimes we just have to cut out the distraction. And then, there's headlines, there's media that trying to stir the pot. So we really want to look at our long-term goal. And there's always going to be something that cause doubts. For example, 3 years ago could be COVID, and then a year ago could be interest rate, and then now the election, banking crisis. So everyone, let's look at the full picture objectively and look at all the historical data, just as David has shared with us, and stick to our long-term goal. So thanks again, David, for putting money into our pocket. And for everyone, please don't forget, if you want more updates and news on our property market, follow our social media. And if you want someone to talk to about your property investment strategy, don't forget to visit our website or subscribe to the link that is showed on the screen now to be notified about future webinars and events. So if you subscribe and you would like to speak to someone, you can visit our website or speak to your Megawatt sales consultant that you know. So we have a whole team of professional and experienced property consultants that is ready to sit down with you one-on-one and to customize the perfect strategy that fits your long-term goal. So that's it for today. And thank you again, David, and thanks everyone for joining us today. We will see you next time. Thank you.
Thank you, everyone.
Bye.